You will notice this year's graphs in both the internet and wholesale segment across all four markets that Group Buy is much farther right than their competitors on both sides. This is due to our increasing models that we used this year that Kyle noted earlier. Now, Deanna will talk to you about year 19 strategy.
The strategic plan for Ideal Shoe Co. in years 19 to 20 had a vision statement that Ideal Shoe Co. strives to be the distinguished provider known worldwide for footwear, setting new trends and lifestyles. Our mission was, at Ideal Shoe Co., we believe that our position as the leader in footwear gives us the opportunity and the responsibility to contribute to a better world for generations to come. A better world in our vision would be safer, more peaceful, and more creative than the world we know today. We believe in being fair, honest, positive, and creative in everything we do. We will keep on making the products our customers love and at the same time bring that vision of a better world a little closer every day. We seek to provide a great financial opportunity to our investors and a great working environment to our employees. The objectives for Ideal Shoe Co. were to offer continuous value-added products to our customers, to achieve our financial target, to set a benchmark in the industry as a cost leader through improved performance, have high advertising in all regions, low production costs, maintain average image ratings, have a high return on equity, maintain profit, have a competitive market share, maintain strong market share, especially in Latin America, and maintain some or average celebrity appeal. Our strategies were to meet the demands of market and supply demanded goods on time without any barriers or hurdles, to offer products at the lowest price allowable to maintain a profit, to make products according to the needs of our customers, to give good hassle-free ambience for shopping with high retailer support, to have a strong market share in Latin America, and to keep production costs low in relation to having a competitive shoe quality. The functional area strategies in production were low cost, low quality, low reject rate, and reduced shipping/tariff rate. In marketing, we wanted high advertising expenses, to utilize all retail outlets/support, to have celebrity endorsements, rebates, and have low costs for on-time delivery. For finance, we wanted to finance our plans with loans, maintain low default risks, have a good credit rating, high dividends, low repayment early, and stock repurchase. HR, we wanted low-cost employees, low reject rates, fair pay, and average benefits. Our SWOT analysis for years 19 to 20 included strengths of high advertising, high brand awareness, retailer support, retailer outlets, wholesale price, EPS, stock price, and model availability. Our weaknesses were in style and quality rating, free shipping, and celebrity appeal. Our opportunities included the private label market, internet market, wholesale market, and celebrity appeal. While our threats were the PEST of the environment, inflation and exchange rates, and Team H had high internet market share and a high celebrity appeal. Our market objectives were 20% in the private label, 15% in the internet label, 25% in the branded markets, and an overall of 30%. Our primary target markets began with Latin America, then to Asia, North America, Europe, and finally ending up with the private label and the internet market. Now I hand it off to Kyle to explain year 19 implementation strategies.
For year 19, we decided to once again increase our internet price. We increased to $72.80. We had a below industry average SQ rating of 2 stars, and we kept our large selection of models available, 485 models in all 4 regions. We once again increased our advertising expense to $79,250. In our wholesale market, we had above average wholesale price. We had a below average SQ rating of 2 stars. Once again, we had a very large selection of models available. As you can see, we had 500 in North America and 1 shy in each of the following markets. We had above average industry advertising expense as we increased to $79,250, and we were tied for the industry leader in North America. Again, we maintained our retailer support at $1,700, and this benefited us this year as we were able to increase our outlets for year 19. For our private label segment, we tried to focus on North America and Asia Pacific. In North America, we had a bid of $21.25, and Asia Pacific of $23.25. We had the industry required SQ rating of 3 stars. For our surplus focus this year, we focused on Europe, Africa, and Latin America. $40 bid in both regions. We did this again to try to get a high return if the bids were accepted. Dave will now speak to you about the results.
Year 19, we largely stayed the same as the year before. Our earnings per share fell to $12.62. Our return was at 31%. Our stock price fell to $195. Our credit rating remained at A-. Our earnings rating is at 73. And we lowered our dividend this year to $5.50. We again repurchased stock, this time 322 shares. As you can see with our market share results, we did fairly well in the North American private label market with 45.2%. We again did very well in the Latin American wholesale market with 23.5%, and also Latin America was the strongest internet market with 18.4%. The graphs largely remain the same as the year before, as again we had very high models but very low SQ rating. As you will see as we move across all 4 regions, we are very on our own and are largely separated from the core group of competitors that we had. And now Kyle will talk to you about our year 20 implementation.
In year 20, we decided to take a drastic attempt by decreasing our internet price at $64.25. We had a below average industry SQ rating of 2 stars, but we did maintain our high selection of miles at 485 in all regions. We increased our advertising expense again this year to $86,250, and we were tied for the industry leader in North America. In our wholesale segment, we had above average industry prices, but we did have below industry SQ rating at 2 stars. We were able to have 500 models in all regions and an advertising expense of $86,250. We maintained our retail support of $1,700 in all regions, and this was not as beneficial to us as we had hoped. We had a decrease in outlets utilized in 3 markets and only increased in Latin America. In the private label segment, we focused on North America and Asia Pacific. The North American bid was $19.98, and the Asia bid was $20.99. We had an industry required SQ of 2 stars, which was a star lower than the previous requirement last year. Dave will now speak to you about the year 20 results.
As you can see, our year 20 results were less than satisfactory. Our earnings per share fell to $8.29. Our return fell to 21.4%. Our stock price was at $113. Our credit rating fell to a B. Our earnings rating fell to a 66. We decided to pay a dividend of $6.25. As you look at our market share results, you'll notice that we struggled in the private label across the board. We only got 27.2% of the market in North America. We did, however, do quite well in both the internet and wholesale market in Latin America, getting 23.58% in the internet market and 20.5% in the wholesale market. As you look at the final results of our graphs across all 4 markets, you'll notice that Group I largely remains across the board in the lower right-hand corner, meaning opposed to our competitors, we had very high models but very low SQ rating. And now Kyle will go over our final results graphs, which encompass our last 7 years of operation.
The next 4 slides will show 2 graphs each about our company's market share, prices, and SQ ratings. As you can see, in most of the markets, most of the years, everything is very consistent, except for down here are SQ ratings. In our Asia Pacific and our Latin America, besides the few spikes that we have, everything is very consistent in the market share. Down here in our price, very consistent except for our SQ rating. This chart shows our net revenues, and as you can see, in year 13 and on, we had exponential growth all the way to the end. Our earnings per share, we had a spike in year 16, and then a decrease in 17 with the economic problems, and then a good rebound in year 18, and then back down. Our return on equity is the same as the last chart. We had a very good spike in years 14, 15, and 16. Year 17 occurred with economic problems, a good rebound, and again, a decline towards the end. Our stock price, same as previous, a very high, 14, 15, 16, decrease, rebound, and again a decrease. This graph shows our credit rating, and unlike the other ones, we had a very high 14, down 15, down 16, all the way to 17 with the economic problem, and again, a decrease in the last 3 years. Our image rating throughout this game was pretty consistent. We maintained about a 70 image rating, which was pretty close to the inspector's expectations. Our global sales from year 13 on spiked at year 17, and then we plateaued in years 18, 19, and 20. And our global market share was pretty consistent all the way through, except for year 17. Because we were doing so well in 16, we were able to fight the economic problems better than most other companies. This graph shows our total liabilities, and as you can see, we had the most liabilities in year 16 with all of our loans. And then again, a decrease, and then again, we declined towards year 20. And this graph shows our cash flow. As you can see, we did have a good rise in cash coming in, but we also had a very high rise in cash going out, which led to a very small net through all years. Deanna will now talk about our exit strategy and our financial health.
The exit strategy for Ideal Shuko began with our financial health. Our operating profit of $160 million, total assets of $590 million, total liabilities of $297 million, and total shareholder equity of $292 million, leaving our return on average equity with 31%, leading into our total cash available of $706 million, total cash outlays of $705 million, leaving us with a net cash balance of $835 million. With this financial health, Ideal Shuko will struggle to survive, leaving us with an acceptable current ratio of 3.17%. The goals and objectives for Ideal Shuko's exit strategy were to offer continuous value-added products to our customers, to achieve our financial target, to market advertising heavily in all regions, and offer products at the lowest price allowable, allowing us to still maintain a profit. We focused on low-cost leadership strategy, a focus strategy, and a multi-regional strategy, hoping for net revenues of $580 million, earnings per share around 16.5, and cash on hand to help repay our long-term loans. Ideal Shuko's leadership exit strategy was democratic, which allowed us each to work together and provide input with one another in our decisions. We also employed a laissez-faire leadership that allowed us to not have to be on top of one another, and no need for close monitoring or supervision. Our success came from working together as a team and helping each other out and adding to team decisions. And now I'm going to hand it off to David to explain words of caution for Ideal Shuko.
Some initial words of caution for the new managers taking over Ideal Shoe Company would be to observe the change in the economic indicators, including exchange rates and tariffs. Consider the production and sales in each region. Also, our long-term debt. We took out several very long-term loans in years 14, 15, and 16, and those caught up to us towards the end of the game. You will have to work hard to get these loans off the books and get out of debt. Also, compare marketing, production, finance, and business strategies to ensure and understand our rivals' next move. This is very important because many of our competitors have very high celebrity appeal in all regions, while we currently have slim to none in all the regions.